Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for our first podcast in the new year, 2026. Happy 2026, everyone. We have a very special podcast today. We are lucky to be joined by David Cohen, who is a partner with Handle Indexes, and then Chuck Fuller, who's a portfolio manager on the Dorsey Wright side of things. We're going to be talking about some kind of not new, but definitely some innovative products that are available there at Handle that we help out with on the Dorsey Wright front. So with that, David, thank you very much for joining us this week.
Thank you, Ian. Thanks for having me.
And Chuck, thanks for hopping on here as well.
Yeah, absolutely.
So David, just maybe to kick things off, I think a lot of our listeners are probably familiar with handles in some form or fashion, but would you mind just giving us a little bit of a background on the origin of the firm and kind of how the idea for products come about?
Sure. HANDLS stands for High Distribution and Liquid Solutions. And it was an ETF that was put together, it was an index that was put together for the purpose of delivering above average income rates. So distributions that were above normal. It's a systematic, transparent, 100% rules-driven process that's designed to deliver sustainable income. We developed it, my business partner, Matt Patterson, and I, in collaboration with Nasdaq Dorsey Wright and the Nasdaq indexing team. So it was a joint effort that we started back in 2015. So we go back to 2015 when we started this, and we recognized that there was a coming or a pending retirement super cycle. You remember everybody was talking about this kind of sign, 10,000 people a day were going to be retiring every day for the next 30 years. And at the time in 2015, the US Treasury, the 10-year was only about 2% yield. And the max withdrawal rate that William Begnan back in 84 said was 4% distribution. And the message was clear that you cannot make a 4% rate with a 2% interest environment, that investors needed income, and we had to come up with a way to develop that. We said we thought 7% was a reasonable manner, and we set out to prove it. And we have a piece that we published back in 2015 or 2016 that stated that explained how we got to that. And what we found was that by employing the basic principles of financial theory, that you could deliver a sustainable, consistent, low volatility kind of distribution rate.
Wonderful. So for the actual product itself, and so just to be clear, the product that we're looking at is the strategy shares Nasdaq 7 handle. It's 7 HANDL index ETF, ticker HNDL, for those following along on the platform or anywhere. How is that specific product structured, David?
So when we were looking at ways to create income, we came from an environment that had done a lot of closed-end funds, and closed-end funds had been used historically as great income drivers in the marketplace, mainly because they contained leverage and a managed distribution that allowed people to be able to smooth distribution rates over time. We set out to create this systematic process that had three basic things that applied to it, which is one, it's total return, not yield, that defines an investment's ability to generate income. Two, diversification is the only free lunch in investing. And three, modern portfolio theory suggests that you should leverage a high risk adjusted return portfolio to increase returns. And that's what Handles was. And it was really the first of its kind to do that. So we went back and said, well, what was the best allocation for the highest risk adjusted returns over the prior 50 years? And it turned out that was a 70-30 fixed income equity portfolio. That became our target allocation. And then we were looking to create a very balanced portfolio, a very balanced process that was balanced on two sides. So we did something a little different. We split the portfolio into two halves. On the one half, you have a basic 70-30 passive rebalance monthly portfolio. So it's aggregate bonds, S&P 500, and the Nasdaq 100. On the other side, you have an Explorer portfolio, which includes 12 categories of ETFs that people typically invest in for income. Those categories are REITs, MLPs, mortgages, growth and income, high yield, preferreds, covered calls, investment grade corporates, taxable munis, utilities, and dividend stocks, and actively managed fixed income. So those 12 categories are where people typically invest. And what we did was we created kind of a dynamic, robust approach to that, along with Dorsey Wright, to be able to get the most out of that Explorer portfolio and to incorporate the benefits of what Dorsey Wright does into the total return performance to be able to make up ground in good markets.
Got it. Okay. And so maybe Chuck, that's a good opportunity to bring in here. So on that Explore front, how does how are we taking a look at the NDW methodology and in that Explore portion?
Yeah, so I mean, if you're a Dorsey Wright client, you'd be pretty familiar with how we're going about doing that. If you're familiar with the Matrix tool on the website, that's basically what we're using to drive the Explore portfolio within Handle. And so, like what David just said, it's got these 12 different groups of basically high income ETFs that it's looking to invest in. One thing that is probably maybe a little bit different than what we would traditionally do. A lot of times we'll maybe not buy the weakest ones or the ones that have the weakest relative strength or momentum, and we'll just buy the high ranked momentum names. In this case, we wanted it to be like what kind of David was saying, more diversified. And so we took a rank-based approach to that. So in other words, we rank or we weight the names within the Explore portfolio based on their momentum rank, basically their matrix rank. So if you're up at the top of the matrix, then you're going to have a higher weight than let's say the number one rank will have a higher weight than number two, which will have a higher rank number three, so on and so forth down the line. I think the top rank, because you figure the Explore portfolio is about 50% of the overall portfolio. If I'm doing the math in my head right, it's somewhere around 7.5% goes into the top ranked one. And it's a pretty small percent. I'd have to do the math to figure out the bottom ranked one, but it's a pretty low amount.
Got
But
it.
doing that allows us to, have that diversification in there while still kind of tilting the portfolio towards the best names in terms of momentum within the space. And it's worked out well, for the portfolio over time. Like David said, the handle was incepted, I think it was January 2018, if I'm right. And since then, the Explore portfolio is done better than, if we had just naively bought, all 12 of those ETFs in an equal weighted manner.
Got it. And so there's no within the Explore, within the ranking, is it strictly relative strength, or is there any kind of like target income in terms of the yield associated with those ETFs?
Yeah, for that, it's strictly relative strength, right?
Okay. And so then, David, maybe on like for the target, obviously with the 7% distribution, kind of how does that balance within the 50% within the Explore portfolio that doesn't have a yield target necessarily associated with it? How is that kind of 7% achieved?
Yeah, well, we were indifferent actually as I said before, total return is what drives the portfolio's ability to create income. And
Right,
and
right.
a couple of things that we did was we incorporated the use of the return of capital into the process because it doesn't matter. The question is whether or not you earned enough, whether you actually the different remember going back to our basic principles, it's
Hmm.
total return that determines an ability of a portfolio to distribute income, not yield. Otherwise, these uber yielding products would actually earn these 35% returns that we're seeing today in the marketplace. They don't earn anything like that. So what we said, we sat down to do is say, well, we had to focus on the total return on the portfolio. And the way we wanted to do that was having a really high risk adjusted return portfolio, levering it up to get to the 7% return that we needed. Now, it's important to know that in every year, you might not earn 7%. In those periods of times, you may see return of capital. But since we brought this product out in every full year that it's been out, with the exception of 2022, it has more than earned its underlying 7% distribution. And the important thing there is that investors then experience that in total return and a growing distribution rate over time.
That makes a lot of sense. And then the comment you said with like total return being the focus, I think makes a lot of sense because with all these high yields, with such a lot of these options overlay products that are coming out, there's a lot of flashy numbers that are being thrown about. So kind of keeping with the total return kind of focus
Right.
definitely makes a lot of sense.
But the important thing is that we have all the categories in there that you might be chasing yield in, but we're taking a systematic approach to it and then smoothing it out over time to be able to deliver what we believe to be a very sustainable dividend.
Right. And so you mentioned there's leverage associated with it. Is that something that you can go into, kind of how that's applied, or how does that
Yeah,
work?
it's very simple, straightforward. They take the entire portfolio and they write a swap to increase the exposure to 1.3x of the underlying indexes, the underlying portfolio's exposure.
Got
And
it.
the reason you do that is because, like I said, in modern portfolio theory, the best thing you can do is take the highest risk-adjusted return, leverage it up because that doesn't affect risk-adjusted returns. Leverage has really no effect on risk-adjusted returns. And this is a very low level of leverage. It's very consistent with what you're allowed to have under the 40 Act. It's not a significant amount of leverage. It's very consistent with what the closed-end fund market uses. And the results have been, that it has been very, very beneficial in terms of driving that sustainable distribution.
That makes sense. That makes sense. So I think that makes sense from a broader structural standpoint. We're looking at, obviously, this fund's been around for several years at this point, and we've been through several different market environments over the past several years. Maybe a little bit of taste, kind of keeping things pretty high level. Obviously, this is podcast focus. We do, for those that are just listening, we do have a video version that's associated on YouTube. If you want to see David and Chuck's face, don't worry about mine. But in looking at how the strategies maybe function in some different environments, you had a nice graph that you shared, David, that
Yeah.
just showed a little bit about kind of distributions since I think February 2018.
Right. Since February 2018, there have been 95 monthly distributions. Okay. And the performance over those 95 distributions has been exactly where we thought it would be, which is significantly higher than the 4% withdrawal rate over a period of time. I don't know if you can show the chart.
Yeah,
Can you
well,
show?
it'll be up on the screen right now.
Perfect. And what you can see is the chart. What it shows is it shows the comparison of the distributions over that period of time since February 2018 through December, and it compares it to either a 4% flat rate or a 4% NAV adjusted rate for withdrawals on an annual basis. And you can see that very consistently, every month after month after month, the handle strategy had delivered a higher total distribution for the month, higher income for shareholders without diminishing the portfolio's ability to regenerate income. In fact, when you go through from 2018, it had a remarkable distribution consistency considering the period that we lived through. From the time handles launched in 2018, we had a very little bit of pre-COVID market. We had the 2020 market crash where the market fell 20%, I believe, in a month. We had COVID, which came in and affected the market. We had an extended period of zero interest rate Fed policy, extensive period. We had the fastest rate hike cycle in 40 years. That was in 2002 to 2003. We had a sharp bond bear market and a corresponding equity market, both losing double-digit returns, which only happened 2 times in the last 100 years. And in fact, the only time it didn't earn at least its 7% total return was which was the real stress test case for this. I mean, this strategy has been stress tested through what was a very, very difficult period.
Yeah.
Over that time period, the distributions have been remarkably stable. They've generally clustered in a tight band rather than swinging wildly. And for some investors, that's what matters most is the predictability. The lowest monthly distribution was 11.0484 cents, and the highest was 15.2834 cents a month on a monthly basis over that entire 95-month period. And to put that in perspective, right now, it's at 12.92 cents on a monthly basis. That was the last distribution. So it's not exceedingly high, it's not exceedingly low, and we happen to be going into a time period where we expect it's not a double, an active Fed hike rate, rate hike period, but rather a period of accommodation and a return to maybe some of the easy money of the past. And we think that will allow the strategy to continue to grow the total return over time.
Got it. That makes sense. So, and that kind of hit on it there with a little bit of the different interest rate policy. I mean, how do you this maybe gets into a little bit of terms of different market environments, kind of how this might perform in different broader structural environments. I mean, it seems like from the graph there, lower interest rates kind of generate a little bit better, obviously on the distribution front when hiking rate hiking environment.
Hiking rates had a negative, I mean, you could not escape 2022, 2023.
Right.
There is not, there, largely you could just look around. Nobody could escape that. It was literally the fastest rate hike period in the last 40 years from the Fed. And that, it was unavoidable. But what you saw was a controlled reset over that time period because we took we had some really good thoughts early on, which was one, take the distribution as 7%, 1/12 of 7% of the NAV on a monthly basis. And what that does is it creates a controlled reset in an environment where things plunge. You're not just giving away more, continuing to give away the shop, you're adjusting it down. And that allows you then to adjust back up as you're going forward. So that was a key component. If you put
Mhm.
just a flat distribution rate against a portfolio, your odds of having a significant event where you go you run out of money over a long period of time become dramatically higher. If you have a high volatility strategy. I've seen some things out here now where they put these target distributions they put the target distributions, the managed distributions, as we prefer to call them, on highly concentrated equity portfolios. You're going to have the risk of severe declines in your net asset value and possible, that's what happens. You can't avoid that. But this strategy is really about, Harry Markowitz's idea that diversification is the only free lunch in investing. We added on top of that the benefit of active management, which comes in the form of Dorsey Wright, which is a systematic approach that has proven itself over the course of my career, which was why I was so engaged to bring that in there, because it's a systematic quantitative approach that has demonstrated, a real ability to provide alpha over a significant period of time. So the two together work well, and we think then that it's that complementary balance that results in the kind of the stable level of income.
That makes sense. So Chuck, within different rate environments in terms of how the Explore portfolio works out, I mean, how do you see which areas kind of came into favor? Are you able to share which areas kind of came into favor or areas to avoid in those maybe the quickly rising rate environment or when it's kind of cooled off?
Yeah, I think 2022 was pretty interesting, for the Explore portfolio. What we found that year, it did better than, just naively buying all 12. And I think largely is because, given its name, it can explore in different areas and weight things higher to areas that are doing well. And specifically in that year, if you remember back, we had the kind of the energy was bucking the trend quite a bit that year. And so the one of the groups that we can invest in is, the MLPs and energy infrastructure. And so just the incredible returns that came from that definitely helped the portfolio out. But that's again that's we never know which group it's going to be, and that's where we have like this diversified lineup of 12. Next year it could be something completely different that kind of rises to the top and kind of carries the weight of the portfolio forward.
That makes sense.
Every month I look at the performance and it's amazing. I mean, the top performer, the bottom performer change out every month significantly. MLPs are as often the top performer as they are the bottom performer. REITs are the same type of thing. All dividend equity tends to gravitate towards the top of the list in terms of risk adjusted performance over time. But it's that ability to switch and go after them, and the diversification over 20,000 underlying individual securities within these 19 ETFs provides really great diversification for investors.
Yeah, and I think that's a good point. I mean, Chuck, we've talked a lot on that diversification standpoint from a relative strength ranking. A diverse inventory is typically pretty good for a productive RS approach, right?
Yeah, that's exactly right. That's what you want. The more options you have for RS to do its thing, the better it's likely to do. There's just more opportunity for it to do its magic.
Right. More of the bigger dispersion between the leaders and the laggards, you get more opportunity for outperformance.
Exactly.
Um, so when we're looking at HNDL, maybe what are, David, some common misconceptions when you get questions, you get people thinking, well, what are the most frequent wrong questions that people ask?
Well, I think the biggest issue is, and I don't know if it's a misconception, but it's maybe a misperception, because people look at it as we're trying to create an asset allocation model. That's not what we're trying to do. We're trying to create a stable, sustainable, abnormally high distribution rate on a monthly income for people who need to rely on on the distributions from their portfolios to fund their lifestyles. You can't do it any other way when you're particularly in the environment when it was the environment that was 2% treasury yields, you couldn't get there. So that was what the solution is. We went about trying to create an optimized portfolio, not a market calling portfolio, but one that over time would have the characteristics to be able to sustain the distribution and recover, more importantly. That's not typically something that people see. And I think if you look at the chart, the chart that we had provided, what you'll see is after 2023, when we had this reset, first you saw it stabilize, then you saw it start to grow as we go into this current environment, which was a rate cutting environment beginning as early as September 2024. So the biggest misperception is that it's an asset allocation tool, and the advisors kind of think, well, that's our job is to do asset allocation. That's not what we're competing. We're trying to give you a solution to deliver income for your clients that's dependable and sustainable. And since 2018, the 95 distribution seemed to have proved that very well.
Yeah, that makes sense. So, I mean, that maybe leads into so when you're thinking about how it kind of fits into an advisor's portfolio, how are you seeing people pair this together? Just taking up like a slot in the fixed income allocation for their asset allocation? Is that kind of how it's positioned, or how are people typically looking at it?
Well, I think it does look, because it does its actual benchmark of the ETF is the Bloomberg aggregate. And it is an alternative to a fixed income position, and it should, that's kind of where I think where people put it. But its best purpose is designed is to drive the total level of income, because you have such a diversified underlying portfolio and such a well thought out product to deliver that takes advantage of both the ETF structure and the fundamentals of leverage and leveraging a high Sharpe ratio portfolio.
That makes sense. So from a consistency standpoint, kind of maybe pairing together with something a little bit more risk oriented, it kind of helps like as a buoy within the portfolio.
Well, you could look at it that way. That is another way you could definitely look at it. I would think that if you're able to drive 7% income out of your portfolio, out of a portion of the portfolio to drive your income needs, at least a larger amount of money to do in some of the higher growthy strategies.
That makes sense.
Mm-hmm.
Well, great. Well, with that, unless you all have any questions for each other, we'll get into S&P 500 2026 price targets here. No, I'm just kidding. That won't be where we're going. But no, this was great, David. Thank you for hopping on. Chuck, thank you very much for joining here as well. David, where can people go to learn more about the product or Handles indices?
They can go to the Strategy Shares website. They can go to handlesindexes.com, handlesindexes.com. And that's another spot, or the Strategy Shares website. Strategy Shares is the investment advisor and the sponsor for the 7-handle ETF.
Great. And we'll put that, for those on YouTube, we'll put that in the description for the video as well, so people can access it from there. Wonderful. Well, again, David, thank you for hopping on. Chuck, thank you very much as well. And
Chuck, good to see you again.
Yeah, good to see you too.
We'll talk to everybody else here soon. Thank you.
Thank you.